Hey guys, welcome to this special update on the latest on the Fed chairman's speech in front of the Senate and the development we have seen in the dollar index and also in the euro dollar, pound dollar, and dollar yen. Now, before we look into any of the details here, as always, I need to stress that trading financial markets is unfortunately risky, and there's a general risk that we lose all of our invested money. Just click on risk disclosure statement down here to know more about what I just said. Okay, so the dollar index is now challenging a major high, which is the February 9th high of 90.60. And if we take out this level, then the dollar index could potentially be on its way to the upside, maybe target the next high here, which is the January 10th high, and in essence just move back up to the 200-day moving average, which is here at pretty much 93.36. Now, what's happening today is that we got the first statement of the new Fed chairman, and his comments were perceived as much more hawkish compared with Janet Yellen's, and that has caused people to reevaluate interest rates, and we have seen a slight uptick for rate hike expectations for this year. It hasn't been like a revolutionary change, but we have seen slightly higher interest rates already in the US. However, though, the dollar here has been ignoring rate expectations for quite some time, and we did actually publish an article on this on February 22nd, where we showed you this chart here. Now, this chart here shows you the dollar index in yellow, and then this is the number of anticipated rate hikes before the end of 2018. So this is on February 22nd. The anticipated rate hikes were 2.82, so almost 3 rate hikes before the end of the year. And you can see here how these two indices were closely correlated, but then by the end of last year, the dollar declined, whereas the expectations of rate hikes increased. Now, the statement from the new head of the Fed reminds everybody that the Fed is ready to raise interest rates, and maybe even more than just 3 times this year. And that has caused the dollar, as we know, the dollar index to move slightly higher. And again, if we take out this high, we could, as I said, have a strong move to the upside. The 200-day moving average is pretty much here. But obviously, if we would link back all the way up to this index, then obviously we could maybe rally all the way up to December highs here close to 104, 105. And that obviously would be a significant rally in the dollar. So today's comments reminded people about this big gap here, and that these markets could, or that we could probably close this gap. Now, to trade this actively, we need a break to this high here. And if one is trading this on, say, the euro dollar, then we need a break to the February low. If we take out the February low at 122.05, then this may open up for a decline to 120.89, maybe fall all the way down to 119.15, and then we'll see what happens. You can see the 200-day moving average is down here, and most likely it's going to be a bit difficult here to challenge these lows. But a little break to the downside here, possibly declining, wouldn't surprise me at all. However, though, the market is technically still above the 122.05 level, so there's a genuine risk here that the market just carves out the low that it was trying to carve out here previously, and then just goes to the upside. So that's really important to remember. But on a break to 122.06, the market again could take out the low, go to the next low, and to the next high, and then the next low. In the case of the pound dollar, the market is still firmly above its February low, which is the 137.68 level, and we need to take this out. At that point, we might move back down to this rising moving average and the 200-day moving average down here. So watch this, which is the 137.68 level. In the case of the dollar yen, if it takes out this high here, which is the February 21st high of 107.98, we could have a little bit of a squeeze to 109, 110 potentially. The case of the Aussie dollar on the daily is a bit of a mess, but if we take out the 77.58 level, it could go to the downside. Until that happens, the market could just bounce. And the New Zealand dollar is under heavy pressure today, and obviously if we take out 71.74, the market could head to the downside. In the case of gold, gold pretty much looks like the euro, with a break to the February high, and that specific level is the 1,307 level could potentially open up for a decline to the downside, maybe taking price as low as 1,265, maybe followed by as low as 12,238. So these are levels to watch, and as you know, we're really close to closing in. So let's take a look a bit at the statements so you can understand what caused the market to be more hawkish. Now, first, I have highlighted here, which I think is important. This obviously not a single truth, but people think is important. But one thing I find interesting is that he talks about the labor force participation rate and how that pretty much remained unchanged over the last few years, despite the retiring baby boomers, putting a downward pressure on the participation rate. So that's something more hawkish than before. And then he talks about the strong job gains have led to widespread reductions in unemployment across the income spectrum in all major demographic groups, right? And that's again a sign of strength, and he's highlighting this, which again people see as something hawkish. What else? He continues in the same line, along the same lines as Janet Yellen, to see inflation and the shortfall in inflation to be something of short-term in nature, and they don't expect this to repeat. So that's again kind of sticking to what Janet Yellen has been saying in the past. Now something new is that they're talking more about fiscal policy, and that fiscal policy is becoming more stimulative. And we know that obviously with the big tax cuts, we could potentially see higher growth, and then this is something that is happening in a situation where the U.S. economy is already doing very strongly. If we look at the unemployment rate, so this most likely could potentially cause the economy to overheat. And here again, mentioning this is something that the market is viewing as something hawkish. And also what they speak about is that they started to reduce their balance sheet. As you know, they accumulated a lot of bonds and treasuries during the Great Depression, Great Depression like 2009, and they're obviously offloading this. And they're saying that the program is running smoothly. But it's obviously what is really interesting is the fact that the US 10-year yield has been continuing to move to the upside. So with them not being natural buyers any longer, then obviously I wouldn't call this necessarily smoothly because the way interest rates have moved up. But it's obviously interesting to see how interest rates in the US have been rallying, not the short term but the long term. Yields have been going up, and obviously this comes on not necessarily because of this, but the fact that they're not natural buyers is something that is obviously not capping yields as they used to. Again, another mention here of fiscal policy, which is important, and this is also really interesting. And he talks about the recent volatility. Doesn't necessarily say that they're talking about specifically about the S&P 500, but we saw a strong decline in the S&P 500. However, though, despite this, he says that financial conditions remain accommodative. So what does this mean? It means that, alright, we saw that decline in the S&P 500, but they're not really that worried about that. And that again is a little bit of a shift and slightly more hawkish in the tone here compared with Janet Yellen. And that is something that the market is taking into account, and that's why we're seeing the euro challenging these lows, gold in particular as well, challenging these lows as well. We've seen a little bit in the S&P 500 how we're seeing a bit of profit taking, which I think is just natural anyway, just because of the decline. But we're seeing in general dollar strength, and the key here going forward is to see, does price survive? Do we challenge 122? Do we trade below it? Then yes, I would position myself for dollar gains in the short term, and then we'll see what happens, right? Because it's a little bit like a self-fulfilling prophecy. If everybody suddenly says, well, of course we're buying dollars, the Fed is gonna raise interest rates, well, then this could close that gap, especially as it's been something that the market has ignored for quite some time. And And if again people start to focus on this, then we could see that closing the gap. For now, this is the first day of this sort of move here, but keep an eye on the news. If you see Reuters and Bloomberg reporting the dollar up because of higher interest rates and so on and so on, again it can become the norm in the market, and because of that we could potentially see a stronger dollar. That information can be used with the help of the technicals I just shared with you guys. Okay, so let's see what happened over the next few days. Thank you so much for watching, and don't forget to subscribe to our YouTube channel for more videos like this. Thank you.